Okay, we're going to look at using financial statement analytics to determine if there's fraud in the areas. And so we're just going to look at two particular formulas. So the first one is the Altman Z, which predicts bankruptcy. And again, it was developed in 1968 by a New York University professor. And the reason behind why it relates to fraud is because bankruptcy causes stress. And it says that this score will predict it within 2 years of the time you do the calculation. So when you do that, you figure within 2 years that stress is going to mount up and potentially fraud could happen. So it's just a guide, not a tool to say, yes, there's fraud. It's more about to say that there's a high probability that this company will go bankrupt in a couple of years. So you'll see there's 5X formulas that you have to do. So X1, current assets minus current liabilities divided by total assets. Pretty straightforward. X2, retained earnings divided by total assets. So that's just the retained earnings of the equity section divided by total assets. X3, earnings before interest and taxes. So you got to take the earnings, you got to add back the interest expense, add back the taxes, and then divide that by total assets. The book value of equity, which is just really your stockholders' equity section. You take the financial statement, ignore the liabilities part, there you go. Stockholders' equity divided by total liabilities. And then X5, which is sales, divided by total assets. So once you've got that, now you can do the Z-score bankruptcy model. So you multiply these factors, again, 0.717 times the X1, then you add that to 0.847 times the X2, and so on down the line. You'll get a score. So the zones of discrimination are whether you think the company's safe or not. It has to score 2.9 or higher, and they're in the safe zone. If it scores between 1.23 and 2.9, then it's in the gray zone. There could be some possibilities of issues there. But if it's less than 1.23, they're in the distress mode, and that is what the Altman Z looks like. Little instructor ad there, or a TIMCERT, is look at the trends of that Z-score over the last few years. If it's getting worse and worse, then they are headed towards bankruptcy. That's an even better indicator than just one-time shot. Okay, here's the killer one, the Banesh M Score, predicting earnings manipulation. So this is one where fraud is perceived to be evident if you come up with a score that meets it. So as Masad Banesh, professor of accounting, Indiana University, developed this in 1999. And for me, that's not too long ago. For you, that might have seemed like a lifetime ago. But 1999, when you think about it, fraud was really a career that started in the late 80s into the early 90s. And so that people started thinking more about fraud, and that's when this whole Banesh M score came up. So there are 8 financial ratios, and they are a killer. And that's why I say what you need to do is review these, do the best you can, look at your Guru focus to see how close you are at the score. So DSRI, or DSRI, is the Days Sales and Receivables Index. So it's the current year net receivables divided by the current year sales, divided by the prior year net receivables divided by the prior year sales. So you'll notice that most of these formulas are going to be comparing current year and prior year. So the gross margin index is prior year gross margin or profit divided by prior year sales, then divide that by current year gross profit divided by current year sales. The ones that might be a little sticky for you are some of the ones where it talks about things like securities. Grab the market securities amount. So if there's a marketable securities amount on there, that's what you want. So that's an asset that you're going to add in that asset quality index. All right. It's not the number of shares outstanding or anything like that. It's the security balance that they have on their balance sheet in assets for marketable securities. Let's see how everything else looks down here. Depreciation, selling and administration expenses. What you want to do is add anything that's non-cost of sales that you can determine to be selling general administration expenses. Sometimes that's just the operating expenses if you can't determine that well. So do the best you can on that. This is an area that can get a little bit difficult in calculating it. And you've got the leverage index, which is all about long-term debt, and the total accruals, or TATA, that's a long one. Income from continuing operations. So these are cash flow statement ones that you're going to be trying to grab off of there. And again, everything compares prior year and current year when you're going through all these calculations. So that should be it. But now what you do is take these particular scores and you start out, if you look at the top, the second dot, it says M score is negative 4.84 plus 0.92 times the DSRI. Now, this is the one that's going to take you a little while. This is the one that I want you to put the presentation on. And again, you just need to be close to the Guru Focus. You don't have to be right on it. And I told you what the window of closeness is. If you got a 2.5 and Guru Focus says 3.7 or 5, that's close. But if you have 50, you got a problem. So that's it. And when you get the M score, look at the very bottom of this. You'll see if the M score is less than 2.22, then fraud is unlikely. If it's greater than 2.22, so if it's 1, -1, then fraud is likely because it's greater than -2.22. So I hope that helps you put together what you need to do for your presentation on the company you've been assigned.